3 stocks, the July 2019 edition. Let's get started. What's up everyone, my name is Ale and welcome back to my world of stocks. I know you guys love your timestamps, so I left them for you down below. Just keep in mind that this is the monthly series where I talk about 3 different stocks every month that I find interesting for the long term. Doesn't mean you should buy them. If you happen to find any of them interesting, then you can research them further and go from there. Now in this month's video, I want to do things a little differently because right now the US-China trade war is all the talk in the stock market community, and a lot of people feel that the weakening Chinese economy, coupled with the entire trade war going on, is crippling a lot of Chinese stocks and leaving them at some pretty attractive valuations. So in this month's video, I want to look at one speculative Chinese stock, and then for the second one, I want to look at maybe a little bit of a safer pick, so kind of a medium risk, medium reward. And then for the third stock, I want to look at a safer Chinese stock and one that I'm actually invested in myself and that I'm very bullish on for the long term. So this should be a lot of fun. Make sure you hit the like button if you enjoy this and want to see more videos in the future. Also, if you want to see past videos from the series, make sure you check out the 3 stocks playlist, which I'll have linked for you down below and as a pinned comment. But with all of that said, let's go ahead and start with stock number 1, and that's going to be a speculative Chinese stock, speculative at least in my opinion, and that is Huya, ticker symbol HUYA, and this is the sort of Twitch clone of China. By the way, Twitch is like a gaming video streaming company here in the United States that is actually owned by Amazon, but it allows users to watch gamers playing video games either casually or competitively online. So it's obviously a big play on esports, and Huya is basically doing the same thing but out there in China, as they are now the #1 video game live streaming platform in the entire country that partners with esports event organizers, major game developers and publishers, and has even expanded into other areas of entertainment like anime, talent shows, and even outdoor activities, as they aim to build one of the most popular technology-enabled entertainment communities in the country that targets younger generations. Now, I'll touch more on their future opportunities in just a second, but first I want to mention that I still consider this a speculative stock, mostly because they haven't been profitable, at least on a GAAP basis, as you can see on this chart here that shows their losses climbing to over $200 million last year alone. However, just because they're not profitable doesn't mean that they're not growing, as their sales have been soaring in recent years, climbing from over $100 million in 2016 to nearly $700 million last year alone. That represents year-over-year sales growth of over 190% in 2017 and still over 100% last year. However, something that is important to note is that analysts on Yahoo Finance expect their sales growth to slow down in the next couple of years. Don't get me wrong, they'll still be growing those sales to over $1 billion a year, but the growth rates will shrink to about 60% and 33% respectively. However, it should also be noted that Seeking Alpha has their EPS growth rates at almost 50% this year and then almost doubling them the year after, as they're expected to be sustainably profitable in the future, which is important for their PE ratio that currently sits at 33 forward. But if those EPS growth rates are to be believed, that PE ratio would drop to somewhere around 9 or maybe even less, which would be very attractive for such a high growth stock like this. Speaking of which, when looking at their stock and the price per share, we can see that they've already climbed by about 20% just in June alone and are up by over 60% so far in 2019. That's a little scary if you're the type of investor that likes to buy stocks when they're really beaten down and is hesitant to buy after such a large rally in a very short amount of time. But on the other hand, the stock is still technically down by almost 40% in the past year, which does make it seem like a decent entry point, although that's ignoring the fact that they IPO'd only a little over a year ago, and that was for $12 a share, which is around half of what they're currently trading for right now at over $25 per share. In any case, their future growth is ultimately dependent on this simple question, which is what is their future potential? Well, just looking at a couple different charts from Newzoo.com, which is a gaming market research company, we can see that the video game market is growing by a double-digit compound annual growth rate through at least 2021 and reaching over $180 billion in revenue. That obviously doesn't translate to video game live streaming, but it does at least tell us that the video game industry overall is very healthy and still growing at a decent rate with plenty of consumer demand. Equally important is the rise in popularity of esports, which is competitive gaming that Huya aims to take advantage of by broadcasting events through their platform, and we can see that esports is expected to top over $1 billion in revenue this year for the first time in history, with growth of over 26%. Along with strong revenue growth, the esports audience also continues to expand at a rate of over 15% this year, reaching close to 500 million enthusiasts and occasional viewers, not to mention that around 57% of those enthusiasts are actually in the Asia Pacific region, making it the biggest market in the world, even ahead of North America, Europe, and the rest of the world combined, with China alone being the second largest region by revenue, and again, that's just a single country compared to actual world regions. Needless to say, the potential for Huya in the gaming market is absolutely there. So the question is whether you believe that management will be able to execute on that future potential or not. And for me personally, I already have too many spec stocks, so I don't really have room to add another, but this is a stock that I will be tracking very closely. As a gamer myself, I do find it interesting. I'm not really into the whole watching other gamers play video games. I'd rather just play the video games myself, so it's kind of hard for me to understand the whole concept behind it. But I acknowledge that they are growing at a fast rate, and it'll be interesting to see if they can sustain that high growth in the future. Okay guys, moving on to stock number 2. This is one that I continue to get asked very frequently about, and the reason why is because the stock has been absolutely crushed and destroyed. I think I've only talked about this stock one time on the channel. It wasn't too long ago, but that stock happens to be Baidu, ticker symbol BIDU. And just like Huya is considered the sort of Twitch of China, Baidu is considered the sort of Google of China, which is definitely big shoes to fill. Okay, now when looking at the reasons why it's sort of considered the Google of China, the biggest reason is obviously because they are a Chinese language internet search provider, and they control over 65% of the desktop search market in China, with over 71% of the mobile search market as well. And that dominance has led to sales growing from around $10 billion in 2015 to almost $15 billion just a few years later, with most of that growth coming from their online advertising business, which operates in a market that is estimated to be worth over $300 billion globally this year, with China alone bringing in nearly $80 billion of that digital ad spending. That represents growth of 22% and accounts for about 70% of total media spending in China. But because of weakening macroeconomic conditions in China, many companies have been forced to tighten their budgets, which has led to less spending on advertisements that are usually placed on Baidu's platforms, which has in turn led to their advertising business only growing by about 3% last quarter year over year. Now you can see here that their sales still grew by around 15%, despite their ad segments making up around 73% of their total sales, and that's because they saw a year over year increase of over 70% in their other segment, which is actually called others. So what makes up the sales for that segment? Well, that's a number of different things, but the primary growth driver has been iQ, which Baidu is the parent company of. Now, you may have heard of iQ in the past being referred to as a sort of Netflix of China, and while they're certainly contributing to Baidu's revenue growth, it's also been a major drag on profits lately, as just like Netflix, iQ needs to spend very heavily on content to attract subscribers and viewers, and Baidu basically subsidizes much of those expenses themselves, which has led led to this latest quarter being the first quarter in 14 years that Baidu has actually reported negative earnings. That's a big deal considering that this is a company that is normally profitable by billions of dollars every single year, as you can see on this chart here. But the recent drop in profits ultimately sent the stock crashing down even more so than it already has in recent history. In just the past year, the stock has crashed by over 55% and over 57% from their highs of $274, now trading for just $117 per share. So why would anyone be interested in a stock that is crashing very hard and is facing very difficult macroeconomic conditions in China? Well, for one, the valuation has become much more attractive with a trailing PE ratio of just 9 and a forward PE ratio of about 15. Granted, the forward PE ratio being so much higher means that analysts are expecting things to get worse before they get better, but if you're a believer that a trade deal gets done between the US and China sometime relatively soon, then many of these analysts could potentially be proven wrong in their assumptions, considering that a trade deal would likely elevate consumer confidence in China, which should lead to companies investing much more heavily on online advertising once again. On top of that, Baidu continues to invest very heavily on innovations as their research and development spending increased by 26% last quarter, while they continue to invest heavily in areas like cloud computing, which their Baidu Cloud just entered the top 5 ranking for public cloud service providers in China and is heavily involved in artificial intelligence, machine learning, and deep learning. But they also have their Duer OS, which is like their sort of version of Amazon's Alexa, and that's grown its installed base to 275 million in this last quarter for an increase of 279% year over year, and continues to be bundled in a number of smart devices like smart speakers, but is also available in certain automobiles. And speaking of cars, Baidu is even investing heavily in autonomous driving and has already launched trials for their very own robo-taxi service through their Project Apollo platform, which is the first of its kind in China. Not to mention that even though IQ is a drag on their profits, it's still a gigantic play on video on-demand streaming with an absolutely massive 96.8 million subscribers just in China alone. For context, Netflix has almost 150 million subscribers, but that's including the entire world. So when it comes to Baidu, I think the story is all about their short-term struggles, but when looking at the long term, it's difficult for me to envision China's leading search provider not being able to turn things around in the future, especially when you consider that they're also heavily involved in autonomous driving, launching the first robo-taxi service in the entire country, but also heavily involved in cloud computing, artificial intelligence, machine learning, deep learning, video on demand streaming, and several other areas as well. So it's hard for me to envision them not being able to turn things around. However, I think a lot of this depends on the macroeconomic conditions of China and whether a trade deal gets done with the US or not. In my personal opinion, I think a trade deal gets done sometime soon, relatively soon, like within this year. I think a trade deal gets done, and I think that will return a lot of consumer confidence to China, and I think that China will continue to add stimulus to the economy as well. So I could see definitely some tailwinds in the future, and I think that'll help Baidu kind of turn things around. It's not a stock that I'm investing in yet, but I have to admit that at these very, very lower, more attractive prices, it's definitely a stock that I'm keeping an eye on. Okay, so those first two stocks were a little risky, right? So if you're an investor who doesn't have a very high risk tolerance, then I think you may like this third stock a lot more. And this is a stock that I actually own myself and that I believe in heavily for the long term. And that is, of course, Alibaba. Ticker symbol BABA. Now, this is actually a new stock to my portfolio that I started adding at the end of last year when there was that huge correction and everybody was very negative about stocks. I started buying Alibaba, and then in the next few months, the stock started recovering along with a lot of other Chinese stocks. So I didn't think that it was as attractive anymore, so I kind of slowed down my buying. But then last month, a lot of negativity surrounded the whole trade war again, and Chinese stocks started tanking again. So I used the opportunity to start adding to my position once more. Now, when looking at their company and their business and their performance, I actually think that they've been performing extremely well considering the difficult economic conditions in China and the whole trade war. And in my opinion, If they're performing this well right now during these difficult times, I can only imagine how bright their future is as the leading Chinese e-commerce company out there in that country. Speaking of which, the global e-commerce market is growing by around $1 trillion every couple of years and is estimated to approach $5 trillion in just a couple more years. Yet even when it reaches that point, it'll still only make up well below 20% of total retail. So what's crazy is that it can get even bigger in the future. And even though Alibaba is much more of a global company than people realize, it still does the majority of its business in China, but that shouldn't really be looked at as a negative, considering that the Chinese e-commerce market did over $1.3 trillion in sales last year alone, which was up by almost 24% and still makes up just around 18% of total retail, which by the way is growing at a faster rate than even the United States without including Hong Kong. So not only is it a huge market already, but it's one that continues to get even bigger. And that's not even mentioning the fact that Alibaba is also controlling some of the traditional retail industry in China through their new retail project, and they have a booming cloud computing business just like Amazon, which is already the largest cloud service provider in the Asia Pacific region and grew by 84% year over year in their last fiscal year. Speaking of which, that was a record year that saw free cash flow climb to over 15 billion US dollars, with adjusted revenue surging by over 50%, although GAAP revenue would have technically climbed by around 41%. But again, this is at a time when the Chinese economy is really struggling, meaning that Alibaba's services are in high demand and will likely continue to help offset those macroeconomic headwinds. To put everything into context, their sales in the past 4 years have increased from around $15 billion in fiscal 2016 to over $56 billion this past year. And management is guiding for that to increase to around $72 billion the following year. Sure, that sales growth has slowed down a little bit, but you're still talking about sales growth of around 30% or more during horrible economic conditions and a lingering trade war with the biggest economy in the world. And all the meanwhile, they continue to be profitable, bringing in billions of dollars of net income every single year. Of course, you're going to have to pay a little bit of a premium to get this kind of company, but their forward PE ratio of less than 19 still seems pretty reasonable to me considering what you're getting in return. And despite the stock already being up by over 86% in the past 5 years, it's still trading at less than the midpoint of their 52-week range, thanks to all of those macro uncertainties that I've taken advantage of myself by buying the stock mostly in these two areas in the past year. In my opinion, it feels to me like the only reason that this stock hasn't climbed higher is because of the trade war holding Chinese stocks down in general, and I think that once all of this gets resolved, this could potentially be a great long-term stock to own. By the way, Alibaba is currently trying to do an 8-for-1 stock split that would lower the price per share to around $20 at current levels, and there's rumors of them doing this to help them make a public listing in Hong Kong that would equate to a raise in capital of around $20 billion for just 5% of the company. That doesn't really change any of my feelings on Alibaba long term, although I do like the fact that the share price would be a little lower and I can kind of add individual shares more often and not have to use fractional shares. But I just thought that I'd give you guys the update, and it should be interesting to see how all of this plays out in the future. Alright guys, I think that just about does it for this month's video. I hope you guys enjoyed it. Again, you can check out past episodes in the playlist down below. Make sure you hit the like button if you enjoyed it, subscribe if you haven't already, and leave your thoughts and comments down below. I'd love to read them and respond to them. I'll catch you guys in the next one. Take care. Bye-bye.